All right, let's talk about auditing. You see that stamp of approval on a company's finances, but what does it really mean? What's guaranteed, and more importantly, what isn't? That's what we're digging into today.
So, let me ask you something straight up. Imagine you see a company, and they've got a clean audit report. Your first thought is probably, great, everything's perfect. But is it? Is that 100% guarantee that there are no problems? Well, the answer, it's probably not what you think.
And look, this isn't just some textbook question. Let's talk about a guy named Samir. He's just reading the news one day and comes across a story that totally confuses him. There's this company that's been audited, got the all clear, and now, suddenly, it's being investigated. And you can just imagine him thinking, wait a minute, if the auditors checked everything, how on earth could something be this wrong? It's a great question.
And you know what? Samir's confusion makes perfect sense. It really does feel like a huge contradiction. So that's our mission for this explainer. We are going to solve this exact mystery. How is it possible for an audit to say everything looks good while massive problems are secretly hiding just under the surface?
The whole answer, the key that unlocks this entire puzzle for Samir, comes down to two simple words, a core concept in auditing called audit risk.
Okay, so audit risk. Sounds a bit technical, right? But don't worry, we're going to break down exactly what it means.
All right, so here's the textbook definition. Audit risk is the risk that an auditor gives an inappropriate opinion when the financial statements are materially misstated. Whew, that's a mouthful. Materially misstated is just a fancy way of saying there's a mistake, and it's a big enough mistake to actually change a decision someone might make based on those numbers.
But let's make it even simpler. Think of an auditor as a detective, right? They're combing through the financial crime scene. Audit risk, well, that's just the chance that our detective gives a big thumbs up, says case closed, everything's fine, when actually there's a huge clue, a major problem that's been completely missed.
So where does this risk even come from? Well, it's not just one thing. It's really a combination of two things that have to go wrong.
Think about it like this. For an audit to fail, two things need to happen. Step one, a problem has to exist in the first place. The company's financials need to have a big error. That's what we call the risk of material misstatement. But that's not enough. Step two, the auditor, our detective, has to actually miss it. Their procedures just don't catch the problem. That's called detection risk. When you get both of those happening together, that's when you have a problem. That's your audit risk in action.
And this brings up a really important point about who's responsible for what. See, it's the company's management whose job it is to create the systems, the internal controls, to make sure the numbers are right in the first place. The auditor? Their job is totally different. They're like an independent inspector coming in from the outside. They're there to check the work, not to do the work.
Okay, so let's dig into that first part of the risk a little more. The part that starts inside the company. Where do these hidden problems even begin?
Again, we have that formal name for it, risk of material misstatement. But please, don't get bogged down by the jargon. All it means is the chance of a mistake. Could be an honest accident, could be deliberate fraud that's big enough to make someone believe something that isn't true.
So what does a problem like this actually look like? What are we talking about here? Well, it could be a company taking a huge expense and pretending it's an asset, just to make their profits look way better than they are. Or maybe they're using accounting policies that are totally wrong for their type of business. Or, and this is a big one, a massive transaction just, poof, never even gets recorded.
And we can actually break this risk down even further into two little subcategories. First, you've got inherent risk. Just think of it as the built-in riskiness of the business itself. A super complex tech company is just naturally going to have more places for errors to hide than, say, a simple corner store. Then you've got control risk. This is all about the company's own security system, its internal checks and balances. Is that system strong enough to catch a problem, or is it full of holes?
Okay, so we've established that risks are everywhere. Every company has them. So, what does our financial detective do about it? How does an auditor fight back?
Well, they definitely don't just show up and start flipping through random pages. It's a very systematic process. They start with something called risk assessment procedures. And the whole point of this is to become an expert on the company. They need to understand the business inside and out so they can figure out where the riskiest areas are, where the problems are most likely to be hiding.
And this investigation is pretty deep. They're looking at the company, its entire industry. They're testing those internal controls we talked about to see how strong they are. They're basically creating a map of the company and putting big red flags on the areas that need extra attention. They even come up with their own predictions of what the numbers should look like. So if something is way off, it stands out immediately.
And here's why that's so important.
All of that homework they do at the beginning, it dictates the entire rest of the audit. By knowing where the risks are, they can then design a custom-built plan of attack. They create specific tests to get the evidence they need, and they focus all their firepower on the areas that are most likely to have problems. It's all about working smarter, not just harder.
Which brings us to the big finale, the single most important takeaway from all of this. We're finally ready to give Samir the answer to his question.
So here it is. An audit is not a 100% ironclad guarantee. The goal has never been to find every single tiny error. The real goal is to provide what's called reasonable assurance. And what that means is bringing that audit risk we've been talking about down to an acceptably low level. It's about risk management, not risk elimination.
You know, there's a line from the actual auditing standards that says it perfectly. It says that assessing these risks is a matter of professional judgment, not something you can just punch into a calculator. And that really gets to the heart of it. At the end of the day, an audit relies on the skills, the experience, and the judgment of a human being. So let's go back to our original question. Can a company with a clean audit report still have major financial problems? The answer is absolutely yes. Because an audit isn't a certificate of perfection. It's a professional opinion, and it's based on reducing risk, not making it disappear. So the next time you see one of those reports,